Frank and Betty Morrison, married 47 years, high school sweethearts. Frank was a machinist, and Betty taught second grade. They did everything right, saved religiously, paid off their house, built a nest egg of over $850,000.
Kevin, I can tell already this isn't a success story.
Frank got Alzheimer's at 73. Betty tried to care for him at home for 2 years, but when he started wandering at night, when he stopped recognizing her,
You had no choice.
$9,200 a month. That's what the memory care facility costs every month for 4.5 years.
That's almost $500,000.
496,800. Matt, good job.
Quick math.
Medicare paid zero. Their insurance covered nothing. When Frank finally passed, Betty had only $127,000 left. So after 47 years of marriage and a lifetime of savings, she was nearly broke at 78.
All because of just one illness.
And you're listening right now thinking, that won't happen to me. You have a 70% chance of being wrong. I'm Kevin Ross, and this is Plan Life Right, where we face the financial realities that nobody else wants to discuss. Today, we're talking about the silent retirement killer that destroys more retirement plans than stock market crashes, inflation, and tax increases combined.
Welcome to Plan Life Right, the podcast that protects your family when life doesn't go according to plan. I'm Matt Floyd.
And I'm your host, Kevin Ross. Matt and I want to start with a statistic that really should terrify every American over 50.
All right, go ahead and lay it on us.
70% of people turning 65 today will need some form of long term care during their lifetime. 70%. That means if you're married, at least one of you is almost certainly going to need care.
So this isn't an if question, it's a when and then how much question.
Exactly. And here's what makes it the silent killer. Unlike a heart attack or cancer, long term care doesn't just threaten the patient, it financially destroys the healthy spouse too.
Because somebody has to pay for all those years of care.
Yeah, the average length of care is 3.2 years, but Matt, average doesn't tell the whole story. Some people need care for like a decade or more.
At what cost?
The national average, get this, for a private room in a nursing home is $108,405 per year. In major cities, it's over 150,000. And guess what? Goes up year.
That's more than most people's entire annual income.
Yeah, and that's just the nursing home care, remember. Home health aides cost $61,776 per year right now. And adult daycare is $21,600. Even assisted living averages 54,000 annually.
So there's no cheap option.
There's no cheap option, and here's the kicker. Most people think Medicare will cover it.
Kevin, let's address the elephant in the room. Don't we pay into Medicare our entire working lives for exactly this reason?
Matt, that might be the most expensive myth in America. Medicare covers virtually nothing when it comes to long-term care.
Nothing?
Medicare will pay for up to 100 days in a skilled nursing facility, but only if you meet very strict requirements. You must be hospitalized for at least 3 consecutive days, and you must need skilled care, not just help with daily living.
So if someone has dementia but doesn't need medical treatment,
And Medicare pays nothing, absolutely zero. And here's what's really cruel, that most long-term care isn't skilled care. It's help with bathing, dressing, eating, going to the bathroom.
yeah, it's those activities of daily living as the
There you
basic
go.
dignities of life.
Right, exactly. And Medicare considers that custodial care, which they specifically exclude from coverage, of course.
They'll call it anything but doing the right thing,
Yeah,
right?
100%.
Well, what about Medicaid? Doesn't it like come in and fill in the gaps?
Okay, so here's how Medicaid will pay for long-term care, but first you have to become impoverished. Okay, that's what people miss. You can keep $2,000 in assets and your primary residence. Everything else must be spent down.
So that's $2,000 in your savings account or a $2,000 death benefit life insurance policy. So you basically have to go broke to get help.
Yeah, essentially, yes, you're basically bankrupting yourself. And if you're married, the rules are even more complex. So the healthy spouse can keep about 148,000 in assets and $3,700 per month in income. Anything above that goes to pay for care.
So the healthy spouse becomes poor while watching their partner deteriorate.
Yeah, let me tell you a story about Margaret. Her husband developed Parkinson's at 69. So she spent down their $600,000 in savings in over 3 years trying to keep him comfortable at home.
What happened?
Well, when the money ran out, she had to put him in a Medicaid facility. She was allowed to keep their house and $148,000. And at 72, she went from being financially secure to living on Social Security and wondered if she could afford groceries.
That's not right.
Yeah, it's not right, and unfortunately, it's reality, And if it happens every single day, it does happen every single day across America. No one's talking about it. Couples who've saved for decades, who did everything right, watching essentially their life's work disappear because just one of them needed care.
There's got to be a better way.
You know what? There is, Matt, but it requires planning ahead, not hoping for the best.
Now, what do you mean by that?
Okay. So most people plan for retirement like they're going to stay healthy until they peacefully die in their sleep. I mean, that'd
Right.
be ideal, right? But unfortunately, that's not how life works.
So we should be planning for disability, not just retirement.
Exactly. You need to plan for three phases of retirement: your active years, your less active years, and your potential care years.
Right.
And so, most people plan for only phase one.
Right. I'm retired. I'm gonna go on 3 cruises a year and take the grandkids to Disney
Yeah.
World every 6
Yeah, we're
months
gonna travel, see the
until I die.
world. Yeah.
But that's just not how it is, and
Right.
7 out of 10 people end up needing help.
Yep.
Well, Kevin, let's get specific about the costs. What are we really talking about?
All right, so let's break it down by type of care, Matt.
Okay.
All right, so first we got home health aid, somewhere around the corner.
Yeah, we got an office right down the hallway from us that does that.
Yeah, that's the person that comes to your house to help with your daily activities. Okay,
And that sounds like the most affordable option.
you'd think so, but home health aides average about $25 an hour, and if you need them 8 hours a day, here's the math: that's $200 per day, or guess what? $73,000 a year.
Right, because you need them every day. It's not just a Monday through Friday
That's right,
gig.
yeah.
It's 7 days a week.
7 days a week, not 5 days a week.
So that's assuming you only need 8 hours. If they have to be there all the time, or if they got to put in 16 hours, the cost goes up.
Yeah, that's exactly right. I mean, many people, like my mother who had Parkinson's, needed 24-hour care,
Right.
right? And so they had a day nurse and a night nurse, right? Which means multiple shifts, right? And that can easily hit, and it did in her case, over $200,000 per year.
So that be more than nursing home care?
Often, yes, but because you're paying retail rates for individual care, nursing home are able to achieve the economies of
Right.
scale, right?
Right. So what about adult daycare?
Well, all right. So here's adult daycare, and when my mom, first got it, after a few years, dad would drive her to adult daycare 3 days out of the week or whatever, and that averages about $82 per day, which sounds reasonable until you realize that that's just 8 to 10 hours, Monday through Friday.
Right.
You still need care on nights and weekends.
So that's a partial solution at best.
Yeah, it can be part of a care plan, but it's rarely the complete answer. And so most families end up combining multiple types of care.
Which means multiple costs.
Exactly. And, I've had a client whose mother needed daycare during the week, a home health aide for evenings and weekends, and periodic respite care when the family needed a break.
So I'm scared here. What was the total cost?
So the first year one was around 127,000, and it went up from there as her needs increased.
So, I mean, she's deteriorating, she's getting worse each year. The needs are gonna go up each year.
Right. So
Right.
you look at like Parkinson's or Alzheimer's, and what a lot of people may not know about those two diseases, they're the same disease, just one hits one side of the brain, the other hits the other side of the brain.
Right.
And so the Parkinson's is the motor skills, but the brain's fine, right?
Right.
Alzheimer's, the motor skills are usually fine, the brain's not.
Right.
But guess what? Towards the end, they all become the same thing,
Right,
right?
yeah.
Um,
The long-term care, that's not something that's, it's not like rehab. Like, I hurt my knee, I'm gonna go to rehab for a
right, yeah,
year.
be there and then I'm
Once you
back.
start
Yeah,
long-term care, you are in long-term care
yeah,
until the
yeah,
end.
especially with some of these, progressively debilitating diseases
Right.
that, it's never going to get any better than it.
Yeah. So how long did their savings last going through all this?
Well, in this case, it was like 18 months. They had $180,000 saved specifically for this situation, and it was gone in a year.
God, and then what?
Then they had to make some impossible choices. Here they could move her to a lower cost facility, which we know is not going to be as good as the higher
No.
cost facility,
Right.
obviously. Get asked family members to provide unpaid care, or they could apply for Medicaid and spend down everything else.
And, so the family, did they become the caregivers?
Matt, that's its own tragedy, right? So adult children, leaving their jobs to care for their parents, marriages get strained to the point of breaking in many instances. Grandchildren who barely know their grandparents because of dementia, it's stolen their minds.
And it destroys the entire family, not just the finances of the couple it's directly impacting.
Right. And it's completely preventable, with proper planning. But people don't plan because they can't imagine needing care.
Right, yeah, it's too scary to think about, we don't like bad things happening to us, so we don't wanna think about their, like, chances that it's gonna happen, but 7 out of 10 is a pretty good
Yeah,
chance.
it's like we always say, hey, if you're 25, interest isn't going to be any cheaper, and you could get tax-free retirement income, and they're like, 65, God, 40 years. That's like
Yeah,
my
that's
life.
2 lifetimes from now.
That's 2 lifetimes from now. It's so they don't do anything, and then they get to 50, 60, they're like,
And they realize they lost out.
yeah, it's
They missed out on 30 years of,
I didn't think I could
compounding.
afford it at 25. That stuff was dirt cheap.
Yeah,
It's same thing, same process here.
yeah,
So psychologists call this optimum bias, right?
right.
And we assume bad things happen to other people, not us. But statistics don't care about optimism.
Right, and that's the stat, folks. 70% of people will need care. That's not optimism, that's math.
That's right. And the earlier you start planning, the more options you have, and the less it costs.
All right, Kevin, you've thoroughly terrified our listeners. What's the solution?
All right. So here's a solution. You create a long term care plan that protects both your health and your wealth, and it starts with understanding that long term care insurance has evolved dramatically the past decade.
Yeah, how so?
So traditional long-term care insurance was always you use it or you lose it. You paid premium for years, and if you never needed care, you got nothing back.
Yeah, it's like car insurance. So,
Yeah,
so
bingo.
people felt like they're just throwing their money away.
Yeah, that's exactly right. Today, the products are very different. They're called hybrids or linked benefit policies, and they solve the use it or lose it problem.
Now, how does one of those linked benefit policies work?
Yeah, so these are typically life insurance policies with long-term care riders or annuities with care benefits in it.
Right, that's the one I see most often.
Right. And if you never need care, guess what? Your beneficiaries get the death benefit or get your money back.
Right. So if you're in the 30% that this doesn't impact, but you've already planned for it, you're not losing anything. Your family's just got
They got
more
some
legacy
Yeah,
money.
there's more legacy money. Bingo.
So it's not wasted if you stay healthy, basically.
Yeah, exactly right. And if you don't need care, these policies can provide substantial benefits. For instance, some offer 300, 500, even a million in care benefit.
And what does a plan like that cost?
Well, you know what? It depends on your age, health, and benefit amount. But let me give you an example. So you got a healthy 55-year-old couple. They might pay $8,000 per year for a joint policy that provides 600,000 in care benefits.
So 8,000 could potentially give you back 600,000.
Yeah, 8,000 a year to give you back 600.
Yeah, that's a heck of a return on your investment.
A little long time, right? And here's the beautiful part. If neither spouse needs the care, their kids inherit the full death benefit, right?
Right.
And if one needs care, the benefits pay for it while preserving the rest of their assets.
I mean, that sounds like a win-win solution, basically.
Yeah. So let me tell you about couple David and Susan. They bought a hybrid policy at age 58, and David developed early onset Alzheimer's disease.
And how did the policy help them?
All right. So the policy provided $4,500 per month for his care for life. So for over the 7 years, it paid out over $378,000.
Nice.
But here's the key: Susan never had to touch their retirement savings.
So she could grieve her husband without worrying about money.
Right, exactly. When David passed, Susan still had her full retirement nest egg plus $200,000 in life insurance benefit compared to that, Frank and Betty that we spoke of early
Right.
from, our opening.
Yeah, I mean, Betty was left with, almost nothing,
Yeah.
but Susan was left whole.
Right. So Susan had money, the other bankrupt.
That's crazy.
And here's the difference here. The only difference really was planning, right? Both couples loved each other. Both saved diligently, but only one protected themselves in case they had a catastrophic cost of.
Uh, what about people that are out there that maybe they can't afford $8,000 a year?
Well, you know what? There are smaller policies, Matt. Even $150,000 benefit can make a huge difference. The key is starting early when you're healthy and premiums are lower.
So how much would you say age matters on a linked benefit plan?
Dramatically, a 45-year-old might pay $3,000 per year for coverage that would cost a 60-year-old maybe $7,000, and a 70-year-old might not even qualify at all.
And what about the health issues?
Even minor health issues can disqualify you or dramatically increase your premiums. For instance, diabetes, high blood pressure, even sleep apnea can affect your.
Yeah, I've seen medications knock people out. Medications that their doctor gave them for something small, like a fentanyl patch for an injury. Every insurance company hates fentanyl patches. I can tell you that right now. It'll drop you to the absolute lowest health grade. Your premiums go through the roof, but I've seen people lose coverage just because, they sprained their knee 5 years ago and their doctor provided them a patch to use for pain that they didn't even use just because they had the prescription written, and it disqualified them for something that was really just an accident.
Right.
So, folks, this is something you need to do while you're healthy.
Yeah, absolutely. And you can't buy fire insurance while your house is burning, right?
Right, exactly.
And you can't buy long-term care insurance after you need care.
Right, yeah. So if you don't have it and you find out you've got early onset dementia or Parkinson's, you're host. Like they won't touch you with a 10-foot pole. Well, Kevin, I can hear some listeners thinking, well, my kids will take care of me. How do you respond to that?
Matt,
You were somebody's kid once.
Yeah, right. That's probably the most dangerous assumption in retirement planning, and it's unfair to everyone involved.
Right. Now, how is it unfair to everybody?
So first, your kids have, their own lives, of course, their own careers and their own financial obligations. They're living their life. Now you're asking them to come and become unpaid caregivers,
Right.
which that can destroy their financial futures as well.
Yeah. And I mean, they're probably going to have to leave their jobs and,
Right.
strains the relationship. They see their kids even less, that sounds pretty unfair.
Yeah, that's exactly it. And the study from the National Alliance for Caregiving found that family caregivers lose an average of almost $304,000 in lifetime income due to caregiving response.
So instead of protecting one person's retirement, you're destroying two.
And that's assuming your children are physically and emotionally capable of providing care. Lifting a 180-pound man with dementia isn't just about love. It requires strength, skill, and often specialized equipment.
Plus, being up close like that and watching a parent deteriorate has to be traumatic.
Yeah, professional caregivers they go home at the end of their shift, right?
Right.
And family caregivers, they never get a break from watching someone that they love disappear little by little, day by day.
But what about those folks out there who say, I'll just stay home no matter what."
Well, that's not always possible, Matt. Some conditions require 24-hour medical supervisions. Others create safety hazards. People with dementia who leave the stove on, or
Right.
Parkinson's patients who fall frequently.
Yeah, so it's not really a choice that's left up to
Yeah,
you.
sometimes it's not. And, here's what's people don't really realize, that even home care can be more expensive than a facility if you need round the clock help.
What about people who say, I'll just self-insure. I have enough money saved." I hear that a lot.
Well, okay, let's do the math, and some people do that. If nursing home care cost $120,000 per year, and you need care for 5 years, that's what, $600,000.
Right.
But that's in today's dollars.
So what about inflation?
Okay. So healthcare inflation runs about 6% annually. In 20 years, that $120,000 might be $385,000 per year. 5 years of care could cost about $2 million.
$2 million?
Yeah. And that's just for one spouse, right?
Right.
If both need care, not at the same time, but sequentially, you could be looking at 3 to 4 million in care costs.
Yeah. Most people, they don't have $4 million just lying around.
Exactly. Even if they did, would they, want to spend it all on nursing home care, or would they prefer to leave something for their children and grandchildren?
So insurance leverages your money.
Right. And you might pay $100,000 in premium over your lifetime, but you receive 500,000 or more in benefits. That's a 5 to 1 leverage on your investment.
What if someone says, these policies are way too
Yeah,
complicated?
you know what's complicated, Matt? Trying to coordinate care for someone with Alzheimer's while managing their finances, dealing with the insurance companies, and fighting with Medicare.
Yeah, and that's complicated if you're in the same room with them. A lot of people don't live down the street from their parents.
Right.
They've moved across country
Right.
or out of the country even. You're
And-
you're in Hawaii, your mom's
and
in
the
Maine,
parent-
and you're trying to figure out which old folks home to put her
Right. And
in.
the parents can't tell them anything. They got Alzheimer's. So,
So a comprehensive policy, it simplifies all this, really, rather than complicate it.
yeah, one phone call, one claims process, benefits that coordinate with each other. It's actually the simplest solution to a very complex problem.
And folks, again, I'm going to remind you, there's a 7 out of 10 chance you're going to have this problem. So bank on that. Now, Kevin, if someone listening right now and realizing, hey, you know what, I need to address this, what should they do first?
Yeah. So first, you need to have an honest conversation with your spouse about what you'd want if you needed care. Okay?
Right.
And where would you want to receive that care? What level of care would be acceptable?
And, that's not an easy conversation.
No, it's a pretty rough. It's easier to have it though now before you're in a crisis,
Right.
And when someone has a stroke or gets diagnosed with dementia, emotions run high and decisions get made poorly.
Okay. So what is step 2?
All right, so research the cost, or step two, so research the cost of care in your area, right? Call local nursing homes, assisted living facilities, and home health agencies. Get real numbers, not national averages, because it could be, you know, cheaper in our Tampa Bay area and more expensive in the Miami area.
Right.
So
Yeah, because costs vary by location.
bingo. And it can be dramatic.
Right.
Care in rural Iowa, for example, or anywhere out in that Midwest is much different than care in New York.
Right.
You need a plan for your reality, not someone else's.
Okay. So we got the first 2 steps down. Then what do they do?
Okay, well, then talk to a qualified insurance professional who specializes in long-term care planning. This isn't the time for for online quotes or captive agents who only sell one company's product. You be
Right.
careful of
Yeah.
that.
You need someone who understands all of the options that are out there for
That's
you.
exactly. And so hybrid policies, traditional policies, short-term care insurance, critical illness coverage, there are multiple strategies that might work for your unique.
So, how urgent would you say this is?
Matt, every day you wait, you're older and you're potentially less healthy. I probably said that on more than
Yeah, I
podcasts,
think
right?
so.
Insurance companies can change your underwriting guidelines overnight.
And what do you mean by that?
Well, I've seen companies stop accepting new applications for certain products.
Mhm.
I've seen underwriting get stricter conditions that were acceptable last year might be an exclusion this year.
Yeah, I mean, sometimes the FDA slaps a warning label on a medication you've been taking for 10 years, and now all of a sudden insurance companies deem it dangerous, and there you go, your rates.
Right.
So, someone who's healthy today, they might not qualify next year at all.
Absolutely. And even if they do qualify, premiums go up every year you wait. So a 55-year-old pays less than a 56-year-old who pays less than a 57-year-old.
Right. So, where can people get help with this?
Well, you can go to Plan Life right now. We've created a long-term care cost calculator that shows the specific cost in your zip code.
And this is free. They don't have to subscribe for $9.99 a month or something like that. It's totally free to the public.
Completely free.
Okay.
You'll see nursing home care costs, home care costs, as well as assisted living costs right in your area. Plus, we'll show you how different insurance strategies could protect your specific situation.
And is there a deadline for any of this?
Well, we update the calculator quarterly with new cost data and insurance options. But more importantly, your personal deadline is your next birthday and your next physical, right?
Because both affect your eligibility and your cost.
Right. And the best time to buy long-term care insurance was 10 years ago. The second best time today.
Well, Kevin, this has been heavy, but necessary. The odds are stacked against us on this long-term care. So we had to have this talk today.
Yep. Matt, in 25 years of doing this work, long-term care planning is the area where I see the biggest gap between what people need and what they've actually prepared for.
Right. And because nobody wants to think about it.
Right. And people will spend months researching a car purchase, but they won't spend an hour planning for the most expensive thing that they might ever face.
Yeah. I mean, folks, you should go out there and go take a tour of 2 facilities. Go to the Rolls-Royce, Rolex, Gold Daytona version of long-term care. Tour that facility, ask all your questions, leave there and go to the cheapest one you can find and see what the difference is. That's your spectrum.
Yeah.
The one that's run by the state,
Right.
it's living off of handouts. That's what you're setting yourself up for if you have to go into that.
That's right.
And unlike a car, you can't return this if it doesn't work out.
Yeah, exactly. And it's not just about the money, Matt. It's about dignity, right?
Right.
It's about choice. It's about making sure your spouse can grieve your illness without worrying about bankruptcy.
And that's what really matters.
Yeah, I've never had a client who regretted buying long-term care insurance or a hybrid, but I've had many who regretted not buying it when they had the chance.
Exactly. So if you're listening and you need to address this, again, there's a 7 out of 10 chance you need to address this. Go to planliferight.com, get the cost calculator, understand your risk, and take that first step toward protecting your family.
And remember, you don't buy long-term care insurance for yourself. You buy it for the people you love so they don't have to choose between caring for you and caring for themselves.
Thanks for listening to Plan Life Right. I'm Matt Floyd.
And I'm Kevin Ross. So until next time, remember, life happens fast. The question is, will you plan life right?
This is the conversation most families avoid until it's too late. Share this episode with someone you love. They need to hear it. We'll see you next week.